Basically, when we talk about financial planning, there are many areas, the 6 different spheres of financial planning, mainly cash management, right? All of us have been managing our cash, since the day we start working and becoming economically active. Risk management, this is the other word for insurance. This is very important, it lays the foundation for safety. Investment planning, right? Investment planning is what many of you are here today to find out more about investment vehicles, types of investment in the market. Retirement planning, all of us are working towards that one day, right? But however, in Singapore, you need to plan this well, because if you don't get this right, at age 65, the government will give you a second career. Okay? Now, other areas would be tax planning and estate planning. So we are able to advise you all these different spheres of your financial plan. Okay? Now, before we start today's session, it's really important that I get this terminology right. The difference between saving, investing, and speculating. Okay? If we don't get this right, we'll be discussing on very different terms. Now, what is savings? Savings is basically meaning putting money aside. That's savings. Okay? Now, investing, what's the definition of investing? Now, definition of investing is the action performed by an individual person, right, for a purpose of profitable return. That is what investment should be. Okay? Now, then what is speculating? Okay, speculating basically says to profit from its fluctuation in its price opposed to its use. You don't need them, you don't buy it for its use, you just buy it for its fluctuation in price. So that is speculating. Okay, so day traders, basically you don't buy to be a shareholder, you buy just to make the difference of the price movement, that's all. Okay, so savings largely is based on interest rate only. Then for investing is a balance of risk and return consideration. Whereas for speculation, it's solely based on return only, nothing else matters. Right? So this is where we get this definition right. Today we are talking about investing and not speculating. Right? Now, before we begin, we need to ask ourselves this question: why do we even start to invest? Why? Right? This rule of 72 will be one of the bases to teach us why we need to learn and to invest well. How many of you heard of this financial rule of 72? Right? Just a handful. Now, rule of 72 is a very powerful rule to know how fast your money double or half based on the interest rate given. Right? Let's do a simple exercise. If today your interest rate, right, rule of 72 is just to use 72 divided by the interest rate. It'll show you how fast your money double. Okay? Now, if you use a 16% interest rate, okay, and you have $10,000, how many years will it take for 10,000 to become 20,000? So what you do, you take 72 divided by 16, and how many years will it take you? Anyone can count? It'll take you 4.5 years for your 10,000 to become 20,000, based on 16%. Now why I use this 16% is because many years ago in Singapore, fixed deposit rates in Singapore, this one is in 1981, fixed deposit rate in Singapore is about 16.5%, guaranteed. So based on those kind of interest rate, do you think that's the best place to put your money? If today you have got 16% interest rate, would you be happy? Quite happy, right? So again here, today's environment has changed drastically. My parents' time, 10,000, 20,000, 4.5 years. Today our time, let's look at the interest rate, today's time. What's current saving account rate? Anybody have any idea? 0.000000 peanuts, right? You get very little. So who was giving the answer? This one is for you. Right? Now, saving account in Singapore is on the average 0.17%. I checked this out with MES website yesterday. Okay? Now, how many years will it take if you take 72 divided by 0.17? How many years will it take for your money to double? Any answer? You'll get this more. 500 years. Who said that? It's for you. Okay. Now, it takes you 423 years. Wrong answer, but very close. Okay. Now, 423 years. Can you wait not? 8 generations later. Okay. Now, fixed deposit 0.54. How many years would that be? 133 years. And for CPF 2.5. How many years would that be? a huge difference again. 2.5 makes a difference, 29 years. Your 10,000 becomes 20,000. Okay? If you invest in bonds, 4 to 6%, it takes about 12 to 18 years. If you invest in equity, if on the average, the actual fact is, investment is not risky. It's usually the investor they are risky. They invest without knowing, then it becomes very risky. Alright? So rule of 72 tells us we need to invest.